Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another Velocity Banking video. And we're going to review Velocity Banking and emphasize how we use both lines of credit and credit cards in our debt payoff journey. So you ever notice that when you talk to most people, it's like the solution must either be A or B. And I asked, like, why not both, right? Like, sometimes I hear like, well, can we just do it with the credit cards? Like, well, why don't you get both? Get a credit card and a line of credit, right? And I think the reason why people fear that they can't get a line of credit is because it's not a heavily marketed product as much as a credit card, right? But you can use both, and I use both in my journey, debt payoff journey, right? Doing velocity banking, and it's been a pretty sweet setup. And the way that I actually do it is I keep a track of all the due dates of credit cards, and I have like, oh, I don't know, like 27 lines of credit or something like that. And then, but I'll just go into it. So first of all, let's go into velocity banking. What is it? It's a debt payoff strategy where you throw all of your money into debt using lines of credit. And you might be wondering, like, what is a line of credit? I've never heard of that term. Well, you've heard of a credit card, and a credit card is one form of a line of credit. So basically, if you take a look at this is a home equity line of credit here. So $373,500. What does it mean? Basically, I go to a bank's website, click a button, kind of like this one, and then they'll dump up to this amount in my checking account, right? So it's basically a tool where you could borrow money, pay it back, and then use it over and over again. And what we're going to use this as our quote main operating account. Okay, main operating account. So let me go back here. So this is what we're going to do. I'm going to copy and paste this into the velocity banking section. And the whole point of this is to show with the same income and the same expenses that we have an easy way to attack our debt, right? So if you kind of take a look at the average American scenario, same income, same expenses, and the only difference between here and here is that the checking account is seen as the final destination of your money, right? Whereas the velocity banking, it's not. So in reality, your bank account should look something like this, where money comes in, it just kind of goes to zero because it's going to go into something called a line of credit. And then, you might have a positive balance here and there when you're paying bills that need to be paid with cash, or usually for me, it's like credit card bills, right? So let me just kind of go here. And then we're going to have something called cash flow, right? Cash flow. And this is going to be different from here because your checking account is the final destination of your money here, whereas velocity banking, your checking account is kind of seen as the middleman for your money, right? It's going to go into a line of credit. And so the way that I use lines of credit is I call it like a personal line of credit and credit card combo. So what do I mean by that? Well, if you take a look at this budget, right? You put your income, you put your expenses, and then you have an expense breakdown right here. So you list every single debt that you have, okay? And then you have also your personal expenses. So the reason why budgeting is so tricky is because most people can't tell the difference between a bill that's a debt versus a bill that's just a general expense, like an ordinary expense. I don't know if that's the technical right term because I get confused by accounting terms like ordinary, like ordinary income. What does that mean? I think it's active income. Anyways, so basically these are the expenses that you have to pay for, whereas every single other payment is essentially a debt, and our whole goal is to get rid of the debt, right? And so I'm going to show you quickly how I use both the line of credit and a credit card. So a credit card, as I said before, is technically a line of credit, right? But it's not exactly the same as a typical personal or home equity line of credit. And if you want to know about me, I'm going to show you about me. I have over $739,000, $739,000 in lines of credit. Yeah, literally $739,000 in lines of credit. I don't know. Maybe one day it'll be a million soon. I don't know. I'm not. I just don't care. But I have over $739,000 in lines of credit, right? And here's the secret to all of it. Here's the secret. Banks don't lend money to people who need it. That's essentially the secret. Okay, so how did I get all these lines of credit? I just went to a bank when I didn't need money. Like, and here's why banks don't lend money to people who need it. Like, don't need it. People get offended by this, but if you ever step into the other person's shoes, you kind of empathize with them. So, for example, I know there are a lot of people who've never been landlords, right? But once you've been a landlord, you kind of think, man, tenants are, what's up with the tenants, right? Like they're kind of irrational. That's what you think. Same thing when you're an employer. When you're an employee, you kind of think, oh man, like the other person sucks. And then once you step into their shoes, like, man, the other person sucks, right? Well, for the bank, the reason why they don't lend money to people who need it is because people who need money don't pay you back. Yeah, I know, right? Like they don't pay you back. People who need money don't pay you back, right? They don't lend money to people who need it. Okay, so they don't lend money to people who need it, right? Right? They don't lend money to people who need it. So that's basically yeah, the secret of banking, which is how I got all these lines of credit and credit cards, $739,000. Now let me show you how I use this, right? So first of all, when you have $1 left over, is the bank going to give you a free and clear line of credit? Like, oh, here's an extra $260,000 line of credit or home equity or whatever. The answer to that is like almost no, right? Like they're almost not, like, unless it's like you have substantial assets. Like that's the only exception I can think of. Like, let's say you have like $1 million of equity in your house, right? It could happen, right? Maybe you bought a home in California at the right time, um, but they won't lend money to people who need it because people who need money don't pay you back. Okay, now. Why do we show free and clear lines of credit? Well, there's two reasons, right? Number one, I have more realistic scenarios. I got two good realistic scenarios in the paid membership, 99 cents. I did it in live streams. I kind of did it like twice, I think, of two people who were on the edge, right? Like one person made 7,000, had only $1,000 left over because of so much debt. One person was making like 5,000 a month and had $4 left over with 22 debts. Oh, I call that one the PhD of velocity banking. So if you want, I put that one behind a paywall so I can see who my most dedicated followers are, right? I call it a cult. Okay. Second reason is because I want to show you that if you knew this strategy before you got into debt, you probably wouldn't be here, right? That's really the second reason. And plus, it makes the demonstrations easier. So the analogy I always like to use is like, hey, you got into a car crash without any car insurance, and then what if there was a car insurance company that gave you car insurance after that specific car crash where you didn't have car insurance? That would be a lifesaver, right? But it's not going to happen. Okay, get the car insurance before you drive the car. Now, I don't mean to be condescending because, listen, I know times are tough, right? Like, I go on the internet, there's a gajillion TikTok videos about how people are struggling. So, I realize I'm a privileged person or semi-privileged, but who knows? Even though I'm privileged, it might all go away in like 3 months or something. Okay, so let me just kind of make my point here is that we'll just start off with a free and clear line of credit just to kind of show you the possibilities. So if I just do this, right? So let me kind of show you here. We use a cash flow index to determine which debts to move into a line of credit. And then I'm going to show you how I use that line of credit plus credit card combo, okay? But the cash flow index is really easy. It's just the balance divided by the payment. And then you create a ranking system. Excuse me. You create a ranking system, right? And then basically you want to pay out the lowest ones first, because what does that mean? The lower the number, you get more bang for your buck when paying off the debt. Whereas the higher the number, that's like, you don't get as much bang for your buck. But they mean two different things, right? Because this higher number has to be paid off, but it has to be paid off last, right? Do you give someone $260,000 for $1,500 of cash flow, or, okay, do you give someone maybe $65,000 for $2,000 of cash flow, right? I don't think I'd give anybody $260,000 for $1,500 $5 back in my monthly cash flow until it makes sense to do so, right? So that's what we're going to do. And then let's go ahead and just move the credit cards, right? So how much is this? 5, 8, 15, 27, 30, 7, 10, 35. And then I'm going to go ahead and sum it up. It's $137,000. $137,000. Okay, so let's imagine that we move all these credit cards into the line of credit. Okay, now if you take a look at this, this is insane. This is what I would show all of your friends and family, right? Like, oh, $1 checking savings to $4,451.84 in cash flow, right? So I'm gonna do this. I'm gonna do this. I'm gonna do this. Okay. And right, so I show you that there. Okay, $4,451 and then 84 cents of cash flow, right? And so how do we pay our debt? Well, this is what I would do. Okay, so you see this 2,100 here. What I would do is instead of paying it directly from the line of credit, I would just pay these personal expenses with the credit card. Now, why would I do it with the credit card with the supposedly higher interest rates rather than this 8% interest rate, right? Is because the credit card has a feature that a personal or home equity line of credit does not have. Okay, and what is that feature? Is a 1 month floating period. 1 month floating period if your balance is always paid off in full, right? So for example, let's say I make a big $2,100 purchase on this credit card, right? So instead of this balance being 35, it will be 2,100. Well, if I float it, meaning I carry a balance on a credit card for 1 month, and then at the final moment, I pull the 2,100 from the line of credit, I've essentially given myself a 1 month interest free period. So as long as I don't pass that 1 month interest free period, okay, then I'll be fine because it'll be 8%. Because if I pull it from the 8%, I get charged the moment I take out that money, right? So that's what I call the credit card line of credit combo, which is for my personal expenses that I can pay with the credit card, and some of them you can't, right? Or it's really hard, like these loans, like mortgages, really hard to pay with the credit card, but you can easily pay with the line of credit. But my point is this: with these general expenses, food, gas, insurance, things I know I'm gonna have to pay for, 2,100. I'm going to pull it out of the line of credit after a 1 month floating period in the statement balance, and then just pay it off, and then do it over and over again. And I'll just spread it out, my general expenses out between, different cards. So if, here's the thing, credit card companies don't like it if you don't use their cards, right? So you just spread it out over different cards. It does require some organization and accounting. Well, it's not like super hardcore accounting. Like the way that I just do it is just I keep track of all the due dates, and then when I'm ready to pull out the money, I just schedule pulling out the money in the line of credit. Okay. All right. So now this is 137,000. So this is what we're gonna do. We're gonna put our entire paycheck into the line of credit, charge our expenses, this $2,100 expenses into credit cards, pay all of these still with the line of credit, right? We don't need to use a credit card for the auto loan, student loan, the mortgage, and then just rinse and repeat over and over again. So technically, it is $4,972.18, but you can float some of the expenses for like 1 month interest free, right? So that will help you out a little bit. Okay, so that's really basically what I would call cash flow management 101. You don't have to just use a credit card. You don't have to just use a personal home equity line of credit. Use both, right? They're all tools that have different features. It's like, what's the difference between a sword and an axe, right? Maybe be skilled at using both of them. Sometimes a sword is better, sometimes an axe is better, but be skilled in using both, right? So, right. So to get the next month's balance, it's the previous month's balance, previous month's interest, 4451.84. And then what we're going to do is take the average daily balance, multiply by the interest rate, and then divide by 12. And now I'm going to go ahead and copy and paste here, right? Copy and paste here. And then in the 35 months, this is all paid off, right? So 35 months, So, okay. So what's going to happen here, okay, is that we're just going to mark that we paid off the loan 137K at 35 months. And then I'm just going to do this. And then now we have 3 more loans at 35 months. And so we have this loan calculator to figure out what the current balance is. Again, use the cash flow index again, take the lowest number. So this is the auto loan, and do this right here. Move that auto loan here, plus 15650.5, okay? And then this is going to be 0. And it's the same thing, right? $2,100 always charged to the credit cards, and then you pay it off with a line of credit 1 month after. So that's basically the strategy, right? Like, and plus you might get like 2% rewards points. You know what's funny? Like, I remember the first time like I heard about like 2% rewards, and I thought how insane it was that people thought it was a good thing. You know what I mean? Like, because they charge 20 to 30% interest, and they're going to give you 2% cash back. Of like, do people actually fall for this? And it turns out it's pretty big. But if you're responsible, it might be, you know, a slight positive. I don't think it should drive your spending or budgeting though, right? But credit card companies know they know like you know what works. They're like, you know, video game psychologists in my opinion, right? Like, you ever hear about microtransactions, how like they hire psychologists to figure out what makes children want to buy like little microtransactions in video games, like what, you know, you make it like a slot machine, get them addicted to gambling at like age 7, and then they're using like $20,000 to buy to buy loot boxes in video games, right? All right, so now where are we at here? So what's our cash flow? Our cash flow is over 5,000. Copy and paste here, and then this is going to be 512212.33. Okay, and then we see that it gets paid off, right? So this is about 38 months. 38 months. And then it's going to be 137 plus 35, 172K, 172K, and then 38 months. So, all right, what are we doing now? So 38 months, student loan. All right, let me go here, 0, 38, 38. All right, so 41 grand we're going to take. Now, normally I wouldn't take a high cash flow index number and move into a line of credit, but because the interest rate is pretty much almost the same, like 0.5% difference, and we have a lot of cash flow, I'm okay moving it into a line of credit. But the thing that you really have to be careful about is that 30-year mortgage and a low interest rate on that 30-year mortgage, 41,788. Okay, so now let's go ahead and do this, and then this is going to be 0. So 5,000. Okay. So 5765.19. Okay. And then 46 months, right? So 46 months. Yeah, we're done. So let me just do this right here. 46 months. And then 172 plus 137. And then it's going to be 309K. So 309K. And then, all right, so this is going to be, all right, so 46 plus 260. So, all right, whoops, I didn't do that yet. So now 46 months, what's the balance? So this is going to be 0, I need 46. Let me just check if I did things right, right? So This cash flow is 5,000. This cash flow is 500. Okay. So yeah. All right. So we got that covered. And then here, $5,765.19. Okay, so we got that covered here. All right. And then okay. So now what do we do here? uh yeah. So 260,000, 1,500. Okay, now we just use something called the velocity banking calculator. And so at this point, you might even use a credit card to pay off a mortgage. I'm not saying you have to, but I've been thinking, like, if your mortgage is your last debt, right, and you're not carrying any credit card balances, and you use something like Plastique, which has like a 2.9% fee, but you have a 1 month period of no interest, I might use a credit card. You know, that'd be really cool. And here's the benefit of using a credit card to pay off your mortgage, right? The interest rate might be higher, but if you pay it off, a month, after 1 month, then you're basically not paying any interest on that mortgage, except for, actually, it's a 1 month floating period. Actually, the cost of that 1 month floating period is 2.9%, right? But you might get some credit card rewards points. So it might be a wash. I'd have to do the calculations, but this is very fascinating to me. So let me just kind of go back here, which is the current balance of the loan. So we have two ways that we can pay it off, right? We could just dump extra cash, or we could still use a line of credit. Now, the reason why I might suggest that we still use lines of credit is one of two reasons. Number one, you don't want to segregate your income, right? Income segregation is the reason why we got here in the first place, because the way that the bank entices you is a combination of psychological norms, right? Like, oh, you want to make sure you have low payments, which everybody is attracted to low payments, not the actual amount that you're paying. Plus, you want to have something in your checking account. But it's kind of like a Faustian bargain, right? Because if you have too many low payments over time, that eats up your cash flow. And that's ultimately the bank's end goal. They want you to be broke, but not drowning, right? Like they want you to feel like you're drowning. I guess it's like a form of financial waterboarding, but they don't want you to actually drown, because you actually drowning means they don't get paid back, right? But if you feel like you're drowning, then that's basically like interest payments to them. Okay. So again, we can directly dump this into the loan, or we could use a line of credit so we don't segregate our income. And another reason why we might use a line of credit is because if we keep swiping our credit cards, we might see the limits just go up like magically, right? So if you take a look at this credit card, $17,500 credit limit, right? $17,500 credit limit. So it used to be 10,000, but I just kept swiping it. Excuse me. I just kept swiping it, and it increased. So if your goal is to increase your credit, you have to use it, okay? And then the reason why you get credit is because credit is like a money access multiplier, right? It doesn't, like, if you have no money, you're probably not going to get credit. But if you do have money, let's say I have $100,000 in my checking account, and I might be able to secure lines of credit or credit cards that are comparable to that amount. So maybe I might have 200,000, right? 100,000 in checking, another 100,000 in credit cards. It's just an example, right? I've never had 100,000. Actually, have I had 100,000 checking before? No, I did one time. Okay. All right. So now let's go ahead and put this in the velocity banking calculator. So if you don't know what this is Renatus. This is where I originally learned velocity banking from. Click the Google form link below if you're interested. All right, so basically I just put the information here, and then you have your current balance, or original balance, current balance. Your chunk amount is how much you're moving into the line of credit. So there's a big difference between moving the whole loan into a line of credit versus doing it in little pieces. Okay, there's a big difference between that. In fact, I can just show you this, and you see that you'll end up paying 10 grand more, which is not really that big of a deal, but you actually end up paying less with a 30% credit card, right? 30% credit card, then an 8% line of credit. I know it's crazy, right? But you do end up paying less. Okay, so let me put 8%, and then this is going to be 3.2, 3.3 years, whatever. So this is 0, and then it'll be 46 divided by 12 plus 3.3, and then it's going to be 7.13 years, and then we're debt-free, right? Debt-free. And then we're still using credit cards, right? So all these 8 credit cards to pay for expenses. And then now, do we need the home equity line of credit? Not really, but that could be your reserve, right? So you have to understand that unlike credit cards, which don't have an real expiration, lines of credit have an expiration for about 10 years, right? They call it the draw period. And then once that draw period ends, the whatever balance is there essentially turns into an amortized loan. I think a 10-year amortized loan, right? So you could probably apply for another line of credit at that time as long as you have the financials, but be wary about what the bank is looking for, right? Because every time you apply for a bank, you always have to get the money when you don't need it. All right, well, that's it, folks. Crayline to Mentorship here with another video. Have a great day, and I'll see you in the next one.